the compliance obligations that come with it, and best practices for maintaining compliance. Investment Advisors Act, the regulatory landscape. The Investment Advisors Act of 1940 serves as the backbone of investment advisor regulation in the United States. It mandates that advisors with at least $100 million in regulatory assets under management, REUM, register with the Securities and Exchange Commission, SEC. For those managing less than $100 million REUM, registration is typically done with one or multiple states. Private Fund Advisor versus Venture Capital Advisor. Understanding the nuances. Both private fund advisors and venture capital advisors provide guidance to private funds. However, they differ in the types of funds they advise and the exemptions available to them. Private fund advisors can avoid full SEC registration if they solely advise private funds and have less than $150 million in REUM. Venture capital advisors, on the other hand, qualify for exemption solely by advising venture capital funds. Venture capital exemption, unleashing the potential for growth. The venture capital exemption offers a unique advantage for advisors who focus exclusively on venture capital funds. Unlike private fund advisors who face a limit on assets under management, venture capital advisors, if they meet the exemption criteria, can provide advice to an unlimited number of venture capital funds without registration. This flexibility allows them to expand their client base and grow their business without the added regulatory burden. Qualifying for the venture capital exemption, meeting the criteria. To qualify for the venture capital exemption, investment advisors must meet specific criteria that demonstrate their dedication to venture capital funds. These criteria include pursuing a venture capital strategy. This involves investing in companies with long-term growth potential, often early or seed-stage firms. Adhering to investment holding limitations. At least 80% of the fund's assets must be invested in qualifying investments, including equity securities issued by qualifying portfolio companies. Maintaining limits on leverage. Borrowings must not exceed 15% of the fund's total capital contributions and uncalled committed capital. Compliance obligations. Ensuring responsible advisory practices. Even though exempt venture capital advisors are not required to register with the SEC, they are still subject to ongoing compliance obligations to maintain their exemption status. These obligations include fiduciary duties. Advisors must act in their clients' best interests, avoid conflicts of interest, and exercise due diligence in investment decisions. Pay-to-play restrictions. Advisors cannot provide advisory services to government entities after making political contributions to officials of that entity. Record-keeping requirements. Advisors must maintain accurate records and circulate relevant reports as determined by the SEC. Best practices for maintaining compliance. In order to maintain compliance with regulatory requirements and ensure the continued success of their venture capital funds, exempt venture capital advisors should implement certain best practices. These practices include implementing a code of ethics. Establishing a code of ethics is crucial for exempt venture capital advisors, as it sets the standard for business conduct and helps ensure compliance with regulatory requirements. A code of ethics should encompass 1. Standards of conduct. 2. Guidelines for addressing conflicts of interest. 3. The appointment of a compliance officer. 4. Reporting protocols. 5. Pre-approval of certain investments. Developing an AML program. While not legally required for venture capital advisors, implementing an AML program can provide numerous benefits in terms of risk management and investor assurance. An effective AML program should include 1. A comprehensive compliance program. 2. A risk-based approach. 3. Due diligence checks. Employee training. 5. Transaction monitoring. 6. Record keeping. 7. Independent audits. Navigating state regulations, tailoring compliance to local requirements. In addition to federal regulations, exempt venture capital advisors must also comply with state-specific registration and exemption requirements. These requirements can vary by state, and it is crucial for advisors to understand and adhere to the unique regulations of each jurisdiction in which they operate. Conclusion. The venture capital exemption offers investment advisors a valuable opportunity to focus on their expertise in venture capital investments while streamlining regulatory compliance. By understanding the exemption criteria, adhering to compliance obligations, and implementing best practices for maintaining compliance, advisors can effectively manage their businesses and support the growth of innovative companies.